Hi guys, and welcome to our podcast. Today we're going to discuss about stock option basics. What exactly are stock options, how it actually works, different types of options, and the benefits it can give us as investors. So what is a stock option? A stock option is an agreement between two parties, a holder, buyer, and a seller, writer. The buyer purchases the right, but not the obligation, to buy or sell stocks at a predetermined price for an agreed upon period of time. Stock options are derivatives, which means that their price derives from a security called underlying stock. Companies and investors use them because of two main reasons: to hedge and speculate. Speculators like buying options because they offer a chance of much higher returns than the ones coming from the security they derive from. The underlying assets could be stocks, stock indexes, commodities, precious metals, foreign exchange, and others. Let's see an example. For instance, a buyer purchases a stock option on shares of Company A with a strike price of $15. The expiration date is the 24th of July. This means that you can, but it's not your obligation, buy Company A shares at $40 a share before or on the 24th of July. In the podcast, we will share more details about the different types of options, their advantages, and other helpful information. There are two different types of options: puts and calls. Call options are contracts which guarantee the right of a holder to purchase stocks at a specified price and by a specific date. If the stock does not meet the price before the contract expires, the holder is not obligated to buy the stocks. Put options give the holder the right to sell stocks at a predetermined price and by a specific date. The seller must, by contract, buy the stocks at the agreed upon price. What's the idea of calls and puts? If an investor buys a call, it means that they believe that the price of the underlying stock will go up. On the contrary, the seller of a call expects the price will go in the opposite direction. If the price does really increase, the holder of the call will buy stocks at a lower price than their current one on. Sometimes investors think that the prices of stocks will decline, therefore they purchase puts. Assuming the price goes down, the seller must buy the stocks at a lower price than the current market value. As we already mentioned, there are two main components in each contract: a fixed price and a fixed date. In stock options, the strike price is the predetermined value at which an option holder can buy or sell stocks. Now, let's talk about leverage and risk in options. In business, leverage is an investment strategy in which people use debt to acquire companies' assets. How does it work? For example, if you want to buy 1,000 shares of a company and one share's price is $15, you have to give $15,000 to acquire them. However, if you purchase an option for the same number of shares but at a price of $4, you can see that you'll have to pay on $4,000. Therefore, for this $15,000, you can buy 3 options, each giving you 1,000 shares. You will end up in control of more than 3,000 shares. The risk in options is minimum. And even though options have many benefits, there are some drawbacks. If the price does not reach the strike price within the agreed upon period, then the holder can lose his initial investment. In spite of the risk and leverage in options, there are great benefits of investing in options, and therefore it is considered as a very interesting choice for part of the investors. Let's review some of the main reasons why you should consider investing in options in detail. The 3 most notable are hedging, speculation, and spreading. The first advantage is hedging. Hedging as a business term is a type of investment strategy which tries to mitigate the potential risk a company can encounter. Even you, without knowing, are hedging. For example, you insure your house in order to minimize the risk in case of a fire or an earthquake. Risk management is a crucial part of any business, so it's only logical that they have a whole strategy regarding this. Many people claim that you need to use hedging, insuring yourself, then options are not a good investment. However, especially if we talk about large businesses, risk management is paramount. The safer you are, the better. That concerns individual investors too. Usually, they don't have the financial resources large corporations have. Therefore, options are very suitable. At the same time, investors want to take advantage of a very attractive stock and protect themselves from potential losses. Therefore, they buy options, low cost and easy investment that offer risk protection. Short sellers also use options to hedge while short selling. This is a process in which someone sells an asset he does not own or has borrowed. The second usability of options is speculation. Initially, options were not intended for speculation. However, throughout the years, many speculators have started using the niche. What is speculation as a financial term? When investors bet on future prices of, for example, a stock, then they speculate. Often they do not have any data or research proving that this price movement might happen. It's just what they feel or want to happen. The purpose is clear: to make a short-term profit. In this regard, options are very suitable for speculators since, as we discussed, they provide leverage. Traders see them as potentially lucrative because a call option can cost a few times less than a share's price. This, on the other hand, is what increases the risk in trading options. In an option, you have to preliminarily define the number of shares, their price movement, and the specific period, which is very similar to gambling. If you fail only with one of the components, then your option will expire, leading to no results whatsoever. Spreading is yet another advantage of investing in options. It is a strategy that combines both hedging, limiting the risk, and also speculation. When you spread options, it means that you trade with more than one, 2, 3, etc. Spread options value comes from the difference between two or more assets. There are different styles of options. Each of them has its own features and can fit into different purposes. Take, for example, the American-style options. They give the holder of the option the right to purchase the stock before the expiration date. Equity options are this style. European-style options. This type gives the owner of the option the right to buy the stocks only a short period of time before the contract expires. Foreign currency and stock index options are this style. Despite these options being limited, the holder can sell them anytime. Another type of option is cap-style option. There are options with an established cap price. The cap price exists to limit the potential profit for the option owner and mitigate potential losses for the writer. The owner of such a contract has the right to buy the stock only for a specific period of time before the expiry date. If the cap price is reached prior to that, the option is exercised automatically. The next type is standardized options. Each of this contract is for 100 shares of its underlying stock. These options are traded on most U.S. exchanges, unlike some of the other options, employee stock options. Plain vanilla options are standard puts and calls with no specific characteristics. If options have some unusual features, then we call them exotic options. For example, they're different than American or European style options because of the underlying assets. Also, the time when the option holder receives a payoff. Unlike plain vanilla options, exotic ones are not that easy to trade with. Binary options, for example, are also known as all or nothing options. Why? The payoff is either fixed if the asset reaches the strike price within the fixed period or nothing at all. Even though the expiry date is individual for each option contract, it is always on a Saturday. If we have to be more specific, this is the Saturday which follows the third Friday of the last month. Keep in mind that option holders should exercise their right before the Saturday, since exchanges do not operate on weekends. Brokers prepare all the documents related to the end of the contract the next Saturday. As investors, we can find many exchanges for options. Some options, called list options, are traded on registered exchanges. For example, Euronext, Boston Options Exchange, and international securities exchanges. It's typical for all listed options to have a strike price and expiry date. The underlying stock can be marked indexes, stocks, commodities, and ETFs. People can buy and sell the so-called over-the-counter options too. These are not traded directly on formal exchanges, but rather between the counterparties. Here it's good to mention two terms and explain why they matter. Market makers are broker-dealer companies which make sure that there's enough liquidity of a stock in the market. The NASDAQ is an example of a market maker. That's it for now. On our website you can find more posts and podcasts as well as calculators and other financial tools. I hope you enjoyed it, and don't forget to subscribe to our podcast channel on YouTube. Do you invest in stock options? We would love to know your thoughts, so feel free to share them in the comments below.